Hey guys, Parmdeep Vadesha here. I'm here in Rome. Perhaps you can guess the building behind me. I'm not even going to tell you what it is because it's so famous. And I'm here on the Tycoons Adventures a trip. And we're having a great time. And we're here with about 30 property investors having a fantastic trip. A couple of the guys were asking me about finance and how that works in buying properties. And so what I thought would be interesting is, what if I give you some different strategies that you might help, especially if you're new to property or even if you're very experienced. What are the different ways people are using to finance properties? It's interesting because we were talking about Rome and how that came about and the Roman Empire. And the Roman Empire was one of the most well-financed, I suppose, organizations there's ever been. And so that kind of got us thinking about how there's a huge amount of money in the world, really. I mean, if we look at the way capital works now in the world, and the world is globalized, and capital is moves very efficiently to the places where it can be best utilized. So people actually do want to invest their cash, especially in the climate we're in right now, where interest rates are quite low, and people have money that's sitting in a bank not really doing a lot for them. So they want to deploy that cash. And so I think the problem investors can have very often is that you're only using one route to try and raise finance, which could be, in most cases, bank finance. And because if they're having struggle getting bank finance, a lot of investors don't really think outside the box from that point on. They just think, okay, I can't get bank finance, so that means I can't get finance. But actually, there's a much bigger world of out there. You just got to understand what you're doing. So one of the big ways people raise finance for property purchases is joint ventures or private investors or bridging finance. They're all kind of the same kind of thing. Bridging finance is where you take out a very short-term secured loan to be able to buy a property very quickly. Often people use that at auction. So you go to an auction, you can buy a property cash, well, you exchange with a deposit at the auction, then you buy it cash very soon after. Now the reason why you might use bridging, bridging costs about 1.5% a month, so it's not the cheapest option, but the reason you might use it is because it's very fast, and there are bridges out there that aren't really that concerned with your credit history and that type of thing. They're more concerned about the property itself because they're securing their money against that. And the reason you'd use that is precisely those reasons, because banks can take a long time, and banks have all sorts of issues about credit and income and all sorts of things like that. In fact, if you've got too many properties, banks might not lend you money. Sounds daft, but it's true. So people then go to bridges, and bridges are great for properties, especially when they're unmortgageable. So property doesn't have a kitchen, or it's got big subsidence problems, or some other issue, maybe a short lease, and so you can't really mortgage it the traditional route. So you buy it cash using bridging finance and then remortgage it after a few months once you've made it mortgageable. Okay, so that's bridging. Private investors are people who are, say, someone like myself. Say if I had, I don't know, let's say we had a few £1 million in the bank, and it's not doing a lot. So a private investor would then be looking to utilize that money in some form. So you're looking to go to those private investors with deals, and you're saying to that private investor, look, I have a deal, I'm happy to do a partnership with you. And so you might do a partnership, or you might do a bridging type of financing, where the private investor gives you the money, you buy the property, and then the private investor will charge you an interest rate every month. Or you might have a deal where you do it up, and you come to sell that property, and you share the profits between you. So the trick is, well, the question is, which is better? Well, there is no better. That's the answer, I guess. It depends on the investor. It depends on what they want. I think that's where a lot of people make a mistake. They think about, well, what do I really want? I would want to, if it was me, I'd want to do a 50-50. But your investors are different. They might be very happy earning only 20% of the deal and happy to give you 80%. So it really depends on the investors. Generally, the more sophisticated they are, and the more they're sort of full-time property investors, the more they're going to want for it, because they're kind of in the game. They know, what's possible, and plus they're probably quite sophisticated in how they do things. And so what you're trying to look for are investors who aren't really full-time property investors as such. They tend to be people who are not in property, they have money, but they want to have some exposure to the property. So that's private investors. Joint ventures are about the same sort of thing. You can either do a partnership or another way. We've also got commercial lenders. Commercial lenders are great for, not just for commercial property, but they do residential as well, buy-to-lets. They love HMOs and deals that are a little bit sort of complex. If you have an existing relationship, if you have a business and you have a good existing relationship with your bank, then commercial finance is really, really good, because you've already got an existing relationship with your bank. They will have a commercial arm, and so you can go to their commercial arm, and you can then discuss in sort of bespoke solutions, in the sense that you can get a drawdown facility, or you can have a sort of an umbrella mortgage over your whole portfolio, allowing you to very quickly buy properties as and when they come up. You don't need to reapply and go through all the messy stuff. And so the terms are a little bit different. Very often those mortgages are repayment mortgages over about 10 years, so they have a shorter life than standard buy-to-let. But and the rate is also often linked to LIBOR versus Bank of England rate, and you're borrowing about 65–70% of the loan to value. So there is, there's some trade-offs, but it's a fantastic way to do things for certain types of deals. So I'd recommend looking at that if you think it's a good idea. We've obviously got buy-to-let. For buy-to-let, I recommend you find a good mortgage broker. If you need one, give us a shout. We'll recommend some of the brokers that we use. So mortgage brokers will check the whole market and find the best deal for you. And so they will know about your situation, income, how many properties you've got, where they are, all that sort of thing. And they will then source the whole market and find you the best deal at that particular time. So they're the main sort of funding sources that people are using. Then you have other things that are a bit more creative. Some people use credit cards if they have a decent limit on them, a credit limit, so they can raise money very quickly writing out checks and things. Just be very careful of the fees you're going to be charged to do that. So credit cards are also interesting. There are companies out there that do no money down finance. That's changing all the time, so just give us a shout and we can recommend people, if there are anybody doing that at the particular time that you see this video. So there are a few. They've also got options and lease options. Now that's not really financing as such, that's more controlling a property to allow you to purchase it later. So that's interesting. Have a look at some of the videos we've got on the Tycoons community website about lease options and options. We've got tons of them. We've got all the documents you need. We've got tons of videos explaining how it all works. So just check them out. That'll all be covered on there. We've also got offshore banks. We've got several Indian and Chinese banks that are involved in the market. So I'd recommend you again talk to the mortgage brokers, see what's out there. But there is an appetite from them because they're very cash rich, some of these guys. They really like development finance, funding developments especially, I find. If you're doing developments, actually, there are lots of different sources for raising finance. Tend to be commercial type banks, and there are certain banks that do very specific development finance, so that they will release the money in stages as the development progresses, and then when you sell the development you then pay the money back plus interest at that point in time. So they can be quite flexible. So that's most of the sort of major ways in which people are raising finance. There's obviously family and friends that can work really, really well. That kind of is going back towards the private investor route that we discussed earlier on. Lots of different ways, but they're the major ones. So I hope you have good luck sourcing your finance. Any questions, please drop us a line or go on the forum or on my blog and ask us a question. We'd be happy to help, and wish you all the best financing your next property purchase.